Today on Wolf Talks, we sit down with Tim Dyer, founder and lead advisor at Dyer Wealth Management in San Diego. With over 2 decades of experience in financial planning, Tim has built his practice around helping families, entrepreneurs, and professionals create long-term financial confidence and freedom. His approach blends personalized guidance, education, and disciplined investment strategies designed to align money with purpose.
Hi everyone, thank you for joining us today. On our interview, we're interviewing Tim Dyer. How you doing, mate?
Good, glad to have you here.
Thanks, man. Thank you for having us. It's a sweet spot you got. So how long have you been in Bird Rock?
I've been in Bird Rock since 2011.
Yeah, so
with the office. Yeah.
with the office right here.
I've lived in the area for about as long, a little longer.
For those that live in Bird Rock, if you're walking by and you see Tim Dyer right by Beaumont's, this is it. This is the spot. And what got you in here? What got you into Bird Rock?
Actually, there was a company that was here that I was affiliated with, and then I was using this as an office, kind of like a satellite office. And then I had sort of formed my own company, creatively named Dyer Wealth Management. I took over the space in its entirety. So I it's almost like a renter that stayed and became the owner.
Okay,
so I don't know the building, but I mean, I just.
What was Tim Dyer doing before all of this? I heard hockey, boating. Where was the backstory?
Well, I've been around a while. I got the gray beard.
We got the wiseness coming out of you.
Since I graduated college, I've always been in financial services. And so, 1998, so I've been in this business coming up on 30 years almost, but 27 years. And what's interesting is my uncle used to manage a major airline's pension fund. And so growing up, this is in Boston, I was sort of exposed to finance, and there were some glamorous things to it, right? Going to these big fancy offices in Boston. But at the same time, my dad, he was a business owner. So he had that entrepreneurial kind of spirit, and, just seeing the things that went with that was attractive. Yeah. And what was interesting is finance intersected those two things. I had this sort of interest in the business aspect of finance, but the entrepreneurial of building a business, serving clients, and the entrepreneurial side. It was a great intersection, and it's taken some different turns throughout my career, but where we are now is ultimately the
in that scope. Like, what was the thing that inspired you the most that your dad did, specifically like in finance and entrepreneurship? Entrepreneurship seems like you're taking a risk, but then big win or big reward, big loss. Yeah,
that's some of it. I mean, you could argue that, and I worked in corporate America for a while too before I actually had my own company. But there's a certain inner fire with entrepreneurs. It's like, hey, I don't want to be told what to do, but I see a path to serve people or add value that I think we could do it in a better way than maybe the constraints of a large company.
Gotcha.
Just to kind of elaborate on the question, though, when I looked at what my father was doing, I mean, I saw good times and I saw bad times, but the one thing that really stood out was I saw that when he did the right thing for his clients and customers, it all worked out in the end. Economies, recessions, things happen in business.
Anything you recall specific? I mean, anything small, like, okay, there's this situation.
Yeah, there is one thing. It's interesting you mentioned that. I can't remember the year, but it was probably somewhere in the late 80s. And the economy there was some real issues, and my dad's business was really suffering at the time. And he didn't lay off any employees. And in fact, he did something different. He took out a loan against our house, and he gave it to his employees as I guess you could call it like a bonus or something. And he said, listen, everybody's having tough times. We'll get through this. This is for you guys. And, use some of the money and enjoy it, or have a nice dinner, or take a little trip or something. But just know that I've got your back. And it actually made the AP Wire, this story about how he had done that. And, I just think about it, and I still talk to my dad, who lives back east now, about it. And it was just a really impactful thing. It was from the heart. And anyways,
It was from their heart, you know.
Yeah, but it wasn't. There was no ulterior motive. It was like, hey, we're all suffering, and there was an opportunity to just, help each other, and there was no strings attached. They didn't pay it back.
So you think like your dad thinking out of the box? A lot of leaders and managers and business owners do not know the financial resources they have to make that play.
Sure.
Is that part of the business? Is that part of your consulting?
Well, what we do here, I would say helping people understand, that's a good point. One of the key values that we bring to the table is just helping people understand some things that either they know that they don't know, or they don't know they don't know, right? Because it's the finance world, investing, retirement, college education planning, estate planning, all these things are, they're not intuitive. We're not taught, you're taught what the cosine is in geometry, but you're not taught how to save for retirement.
How to dissect a frog or stuff like that.
Yeah, exactly. So, we help clarify and create some confidence around that. But one of those things that I really enjoy about the business is that aha moment. That moment where somebody just, it makes sense and they get it. And the stress levels go down, the worry goes down. Or in the case of some of our clients that are retired, they're now spending their money worry-free, right, and guilt-free, because they know that there's a plan around it to live that life that they have envisioned.
They have envisioned, and they work hard. I imagine, and with total ignorance, one of the hardest things I feel for your clients will be trust. I imagine, like, why am I giving you my wealth management to you?
Sure.
So how did you build that trust? How do you get to where you are?
Well, been doing it a while, and so a lot of our new business does come from referrals and client introductions. That's some part of it. So the credibility of those referrals is important. Recently, the SEC, the Securities and Exchange Commission, they now allow us to use Google reviews. We couldn't even do that. I think as short as 5 years ago. Can't use testimonials and things. Anyways. So some of that is nice, because that's a way to build trust from real people that we've worked with. So that's been helpful. But the other thing is, you really, like anything, you've got to be really clear about what you do, and you need to do what you say that you're going to do. And so just, being trustworthy obviously is a big part of it. But, it's funny, I equate it sometimes to, you take the Porsche dealership up in Miramar, the guy's got this beautiful red Porsche and whatnot. And he says, this is the car. And the guy walking in, or gal, to buy that Porsche, they go there wanting to learn more. They're excited about it, Right. And so, and he just has to sort of explain it in the right detail. With this, in a way, we're selling intangibles, right?
Right.
And so helping people understand, numbers, but put some tangible nature to it. It takes some time, and by providing people that clarity, it gives them confidence, and it builds trust. So it just takes time.
Yeah, it takes time. You already build that credibility, and I see you're doing like LinkedIn, you're doing podcasts, you're doing some lead magnets, all that stuff. Right now, what's working the best for you to get those leads?
From a marketing perspective?
From a marketing perspective for your business.
Yeah, LinkedIn's been a really powerful area. I don't do a lot of direct posting right now on LinkedIn, but just through connections, and there's some filtering that can be done where I can send some direct messages. For example, we do some business with Qualcomm here in San Diego as a big, well-known company. And I wrote a book specifically for people that work there. And so, I'll just drop them a note. Hey, I wrote this book. I'm happy to send you a copy.
Oh, that sounds fun. When does this book release?
No, I've had it for years.
Oh, you had it already for years.
So we've updated a few versions, but it's talking about some of the things that either they're facing now, or that they're going to face in the future as they build their net worth and complexity and things like that. So we sort of get ahead of the curve with it on them.
Gotcha. Where can people get this book?
I don't have it on Amazon or anything. We've got a physical copy over here, but we just send them a copy. I've got a stack.
So if they're interested, they can go to your LinkedIn, go to your website. Hey man, I'm kind of interested in this.
Yeah,
book.
just reach out. We'll send a copy.
What are the 3 things that the book can bring value to them? Like if I buy the book and I read it, what I'm
it's free for you.
Thanks.
Specifically,
awesome for you.
Some of the lessons in the book really are a lot of times people get really hyper focused on their investment portfolio, right? What are their stocks doing? Are there other stocks that can do better?
Yeah.
And sure, that's a big part of the sort of wealth management umbrella. But think about this for a second. If let's say the market historically has produced a 10% return, right? Average rate of return. If you improve that, right, maybe you improve that to, I'm just spitballing here, there's no guarantees, but maybe 12 or 13 or 15%. Just using a hypothetical example. Okay, that's meaningful. But what if you save somebody 30% in taxes, right? That moves the needle much more than all the extra worry about just getting a better person. Let the market do its thing, right? And there's ways to optimize that. But be thinking about other things, like what's my lifetime tax bill? What things can I put in place to minimize the taxes? Because every dollar that you save in taxes is like a 33%, here in California, it's almost like a 50% savings. So that's way more meaningful. And so we help with that in our wealth management process.
How can we, like me starting to build patrimony for my family, and we got our 20-year-olds that are in production, things like that.
Behind the scenes. These are the
scenes,
important guys, because they know how to do that.
They do all the rubber. And they want to build wealth. Some of them I know are investing. But like in us, when we're producing something, we have our pre-production, we have our production, and we have our editing, right?
Yeah.
In those terms, in investment, is there some sort of things like you invest, you watch the market, and then you have to pay taxes? Is that how it works if you put it into that streamline?
Yeah. Okay. So let's take it from a 20, something year old, 20, 30 year old, somebody that's just getting started. They're getting started in their career. There's a lot of things in front of them, a lot of different, choose your own adventure paths they can take. Okay. But when it comes to setting themselves up for the future, the first thing that they really need to understand is the power of compounding, right? The power of compounding. And that's that as you start to save money and make money on those savings, you start to make money on the interest that you make, and then you start making money on that interest as well as additional savings, right? So it looks like a hockey stick curve. It goes like this. And the single most important impact when it comes to, setting up yourself for the future is time. You could put in a little amount of money up front, but do it for a long period of time, and you're going to have a lot more money in the end than somebody that waits and starts putting in a lot of money in later years.
How many types of savings are there that they can put that?
Well, I'm speaking generically as far as you could put money in an investment account, you could put money in a bank, a savings account. Those have maybe lower rates of return, but understanding that the money that you're, like in a 401k, if you're at a company that offers that, or even if they don't, you can set up something called an IRA, individual retirement account, where you can put $7,000 a year into it, and just let that keep building up over time. I'll give you an example, and I've got to think of the exact numbers, but we've got a PDF resource that shows an individual that is 25 years old, okay, and they put in I think it's $1,000 a year for 10 years. Okay, maybe it was $10,000, but $10,000 a year for 10 years. Person number two waited 10 years, and then they put in $20,000 a year for 20 years, right? So person A puts in $10,000 a year for 10 years, $100,000 outlay. Yeah. Person B, they wait 10 years, but then they put in $20,000 a year for 20 years. So they've essentially put in $400,000. The person A has more money at the end of 30 years total.
Because time.
That's
time.
That money is compounding faster. Yeah, so, it's an amazing, it's really, Warren Buffett calls it, whatever, the seventh wonder or eighth wonder of the world, the power of compounding.
So if we jump to the future right now, how old are your current clients in wealth management? I mean, they're retired, they must be in their 30s.
I think our sweet spot is really, you call it pre-retiree, but it's somebody that it's not so far out. So let's just say it's in their early to mid 50s. When they first engage with us, right? And they've got an increased amount of responsibility at work, whatever they're doing at work. They're kind of at the top of their game. They've been promoted. Their kids, they've got a full household, right? So there's more responsibility with that. They just have limited amount of time because their resources are so spread out through their work commitments and their family commitments. But their net worth has grown, right, to a point where it's the stakes are high, right? If you make a mistake with $10,000, well, you could, go out and mow a few extra lawns, right, and make up $10,000 in the summer. If you've got $1 million and you make a mistake with that, or $5 or $10 million, you can't just replace that, right? That's years of work and accumulation. So the stakes get higher as as the responsibilities and their net worth grows.
So are these clients already have savings that have compounded, or they're barely started?
For the clients that we work with, mostly, they are. They have investments. To give you our demographics, I said early to mid 50s, but our average client is 57 years old, and they have about $2.5 million of investable assets with us. Now, they might have real estate and some other things, but and so that gives you some context. Now, when we first meet with them, they are usually in their early 50s. Or sometimes, they're right at retirement and they need some help sorting some things out, because you're going from paychecks to no paychecks. You got to figure out how to do that. So we kind of meet them at that point, and we're helping them maximize their accumulation years, those final accumulation years where you got to really get it right, and then get them to and through retirement.
Got it. Have you ever got a client and it's a red flag, like, I can't help this?
Oh, for sure. Yeah, for sure.
What are those red flags?
It's usually somebody that just sort of immediately reaches out and they say, I've got this account and I've got these stocks. Should I buy Bitcoin with all of this? They're usually looking for something that's unrealistic, right? And that doesn't necessarily mean it hasn't happened, right? There's a lot of people that have become millionaires. We just used the Bitcoin example, right? But over the years, it's been a lot of different things. It's been gold, it's been real estate, and it's just they're chasing performance, and that's just a fool's errand. It always ends badly.
And anything,
right?
Like
so that's
shortcuts are easy. Help me understand. Like me, I sometimes think that investing or financing, it's a bit of a gambling. Is it? Help me educate that it's not. Because it's not exact science either, but I'm sure there's something there that it's not gambling.
Well, that's right. So one of the things, it's funny because my uncle, who was the money manager, he used to call me after he retired. He'd check in on the stock market, and he would always say, "Hey Tim, what's the casino doing today?" And it was just merely a kind of a joke, but it made me think of that. So the difference between investing in gambling is, with investing, when you learn the foundational principles of how to put your money, essentially what you're doing is you're investing in companies or funds that are investing in companies, and you're participating in the growth of those companies in the future, right? If you go to Vegas and you're at the roulette wheel or the blackjack table, the hand comes, you win or lose, right? And the odds are, it's 50-50 or something like that, When it comes to investing, if you look at investing, say, in the U.S. stock market, 70% of the time it goes up in the year, right? So if you look back to 1900s, the last 130 years, the stock market has gone up 70% of the time if you look at the returns each year, right? I see. But on a one-year basis, right, to have a positive return, it's about, 50, well, no, it's about 70%. But as you go out farther and farther, there's never been a 10-year period where the stock market has lost money if you reinvest the dividends. I see. Right? So investing isn't about short-term necessarily. Now, there are people, I point over here because there's a TV with the financial media on and CNBC. Yeah, some of those people are interacting on information on a short-term basis. I would call that trading. And to a certain degree, I would call that gambling. But putting your money away in a sound financial strategy, and
it's always a sure return. So
you got to be careful how you say that, right? Because look, the sun could come up in the west tomorrow. I bet heavily that it doesn't, but that's one thing about our industry. We're very, very careful about what we say.
Exactly. Yeah, right. So I understand. Yeah. I can relate it to, like, if I'm doing like AdWords, they give me $5,000 a month, and they go, okay, how many clients I'm going to get back?
Right. That's
right. The first couple of weeks is going to be exploratory for me to see the ecosystem, to see your health and your website, so I see similarities. I'm kind of like understand on my own terms.
Well, people love certainty, don't they?
They do, yeah.
They love certainty, and there's a degree of it that you can get and provide, but there's never absolute certainty.
Yeah.
It's kind of,
for red flags for me is like, they come clients is like, yeah, we're going to go viral or we're going to make lots of money. It's like, I'm going to be honest with you, I don't know yet. In 2 weeks or 3, I will get you how accurate we can put our finger that we can do it.
Right.
But I can't say that we will. I'm going to be honest, like nobody can. They're just,
That makes me think, so let me set the framework for some definitions, because we can use a little jargon here and get.
Okay.
So when I think of wealth management, Dyer Wealth Management, I think of it as really kind of 3 different silos. The first silo, or service, if you will, is financial planning. So it's setting forth the strategy that the particular client, helping them, create a roadmap that gets them through life's milestones,
Yes.
right? Planning and strategy.
Yes, I'm with you.
The middle silo is investment management. Now, we do some of that in-house. We do some other things where we bring in outside professionals to manage certain parts of the portfolio. But the third part is tax planning. That's different than tax preparation. Your CPA, they file your tax return. That's tax preparation. We're doing tax planning where we're looking at things in the future and running different scenarios. Okay, if you sell the house in 2025 versus in 2026, okay, you got a big bonus this year. So some of those things, just to use a high level example.
Right.
But those areas, planning, investment management, taxes, and then estate planning, which is if something were to happen, it's not all just at the end of
No, I get
at
it.
the end of life.
Because
There's things along the way.
We needed that. Like my wife is doing the taxes, and she goes back to me. It's like, this year we should have bought more gear.
Yeah.
It's like, and I go, we should have bought that $5,000 light and the $10,000 camera that was. So that kind of planning or like selling stuff. Okay.
Yeah, and for our business owner clients, that stuff is really impactful because sometimes they get lumpy payments or receivables or some other things like that. But going back to tax planning and then estate planning and some other things, those fall under that umbrella of wealth management.
Got it. Yeah.
Now, there are some financial advisors out there that maybe they just focus on one particular area. As a wealth manager, we oversee all of those different areas. So we act kind of like the quarterback for the client, right?
How so?
Well,
I felt it was more holistic, but why the quarterback?
Yeah, and what I mean by that is you don't have to go out and find the planner. You don't have to find the investment manager. You don't have to find the tax planning. Like, I quarterback that, and we bring in specialists where we need to. Yeah,
okay.
Yeah, exactly. Gotcha. As opposed to having, again, we see clients, they've got a CPA. He doesn't talk to their investment professional, and he doesn't talk to their estate planner, and so there's no cohesion there.
In your industry for investment, there's a specific industry, like we only do tech, medical, something, or you're very broad.
From the investment management?
Yeah.
From the client perspective or from the investment management?
For investment management.
No, it's broad. We're not,
Got it.
we can go anywhere with, different strategies and things like that. So I would say that if you're looking in that investment bucket, there are all kinds of people. You might find an investment manager out there that says, hey, we specialize in buying tech stocks or something like that.
Yep.
And that is just their lane. Now, somebody like me might use them for a piece of the portfolio for the client, right? But that person is just running that strategy on their own as a standalone.
Gotcha. The term wealth, do you feel that wealth is the same thing in the 80s, now in the 2000s, and now 2025? Is it what is wealth back in the 80s versus now?
Well, I am old enough to remember
the 80s,
the movie Wall Street with
Gordon Gekko.
Gordon Gekko, right? Now he was talking about greed. Greed is good,
right?
But I think wealth back then, maybe was sort of ye with the most money wins kind of thing, right?
Right.
Like they just, it's funny, Trump's the president, but I'm thinking like, you would think Donald Trump was sort of this billionaire back then, and he was like, okay, that's wealthy, right? I would think of that now as rich, right?
Rich.
Somebody with a lot.
I know, there's a big difference between rich and wealthy.
Yeah,
there's a gap.
Someone with a lot of money is rich. Again, this is merely my perspective,
yes.
But I would say somebody that is wealthy is somebody that has complete control of their destiny. And you could maybe even define that as financial independence. You and I both know people in our lives that maybe they don't have a lot of money, but they are the happiest people in the world.
Yes.
Right? And we know people that seem to have everything and they're miserable because they're too busy and they got, so many different things.
So the outlet rate there would be time.
Time.
And then we go again in the compound at time.
That's it.
That's very interesting.
That's it.
Time could be equal wealth, but
Yeah.
also peace of mind. Also, I don't know. That's the wealth. So, what is the wealth of the future then? If it's not the Gordon Gekko, if it's not right now the tech bros or anything, what is the wealth of the future with AI coming and all this stuff?
Sure. Now we're starting to see that, and what I mean is, I would even say the tail end of millennials or Gen Zs, but that generation was really comfortable with not having to go into an office or working remote. It was more important for them to sort of be able to live in a place where they had the things that they need, right? Somebody would rather live off a laptop down at the beach than maybe be making more money in New York City and dealing with all the hassles of that. You know what I mean?
Yes.
Whereas my generation was like immediately went to New York or Boston or San Francisco or something. It's like, no, you have to.
Competitive. Yeah.
We've got to move up the corporate ladder, and so it is nice to see these other generations think that it isn't. There's some sacrifices with the time for money.
Because we have that sacrifice of time for money, but I feel that the current generation is more experiential. They live for experiences. They live for that pursuit of paradise. Versus our generation is very competitive. Very competitive. And we that's what we like. We like to be competitive. We like to be challenged. We like to be pushed and see how many times we can come back like a Rocky.
Yeah. It's exactly. And I think where we sit, again, I'll be 50 this year. I think, and I'll just speak for myself, but I have just a little bit of both. And I do like the competitiveness, but I'd say one of my core values is experiences. I'm going to pay that extra money to get the front row seat. I'm going to, I'm going to go see if the concert's in town instead of, should I do it? I'm going.
Right.
And I'll let the chips fall where they may. And with the older generation, the clients that I work with, a lot of times, they saw people from the generation before that went through the Great Depression. And so there's a little residual, little hesitation with that. And I have to tell them, listen, here's our plan. You've got this money. I'm not saying you got to spend every dollar of it like Brewster's Millions, right? The movie, but you got to enjoy it. You've got to go do it.
What do these wealthy people enjoy the money with? What do they do? They got so much money they can't spend. What do they enjoy doing?
It's not material things.
It's not material things.
It's supporting their children and grandchildren. It's supporting the causes, philanthropic causes that they care about. I mean, you think about it. For them to put some money away. I remember one client a long time ago when I was early in the business. She had a lot of money. She was in her late 80s.
What's a lot of money? Just right now, 2025, we talk about.
Well, it's all relative, right?
Right. Millions, billions. Because at 1 million, I don't think it's a lot of money anymore.
Well, 1 million is a lot of money, but
for the context.
But it's not going to get you as much as you might think, right? You're not done.
Because I remember back in the day, you were like, oh, it's $1 million house. Oh, wow. And now So that's what I'm saying in context. Sorry to interrupt you. You were saying.
Well, just to finish that thought, she was thinking, she at the time, I think she had $4 million. And in the early 2000s,
Gotcha. Okay, back then that was a lot of money. Yeah.
And so she had she had a granddaughter, and I started to explain to her what a 529 account is. And that's an account that you can put money in for future college expenses for somebody.
529,
right?
okay.
Now, you can actually put in, there's only so much you can put in or give away without having to file a gift tax return and things like that. But the point is that she could actually put $50,000 in per year, but she could front load 5 years worth of that gift, right? So she put $250,000 in to this account. And by the time the granddaughter got to college, it paid for her college, her grad school, and now there's money left over for her eventual child, the grandchild's child.
Wow, from that account, just because it was there.
And all that money is tax-free.
So how it was 529?
That's the IRS code. That's what they call it, a 529 account.
And how does that work? You put it in the bank, or where does it live? Help me.
You put it in a investment account that is titled a 529.
Got it.
So what happens is, believe it or not, each state has a different type of account. It's a 529 account, but each state has a different sponsored one. This is sort of the operational side of things, but essentially you're putting money into an account in your name for the benefit of, let's just say, your child.
Yeah.
And as long as that money is growing without being taxed, and as long as you pull the money out for higher education expenses, right, college or private school or something like that, then all of the gains or profits in that account are not taxed. It's tax-free. So it's a very powerful vehicle.
Yeah,
especially, remember how we talked about how time, especially if you do it.
Yes, early.
When my sons were born, that first day, I opened up
first thing you
2
did.
accounts for them at Charles Schwab. We started putting in, a couple $100 a month for them each, and off they go. I kind of figured out how much per month they needed to put in so that when they got to 18, it would cover the, inflation-adjusted college expense. You always want to have an emergency fund, right? Something happens or, you want to have some money for a rainy day.
Yeah.
And then the money that you kind of draw that line in the sand and figure out what's appropriate. For different people, it's different amounts. But then from there, start investing systematically and let that power of the U.S. markets compound on their behalf.
Gotcha. Where are we right now, 2025, October, in the U.S. market, and where are we headed? What's your best forecast? What's going to happen?
Yeah, bit of a loaded question, right?
And we can break it into pieces.
So the stock market's at all-time highs right now, right?
Okay.
And so the first thing that might come to mind is, okay, well, it's high. That means it has to go low, right? But it doesn't work like just up, down, up, down, up, down. I want you to think of it like a yo-yo on an escalator, right? So the yo-yo's going up and down, but the escalator is going up.
That's a good analogy.
Right?
Thank you. Okay.
Or a Ferris wheel on an escalator. Yeah, the market's going up and down, but the escalator.
It's still going up.
So on a year-by-year basis, it might be up or down, round and round, but over time, it's working its way forward, right? Because let's step back a second and think about why. Think about the companies that are out there: Apple, Microsoft, Amazon, all these different things in all the different sectors. All of those CEOs are out there trying to figure out how can they improve their business. How can they grow the value of the business for their shareholders, right? And that ingenuity is what's driving everything higher.
I see.
And so even though we can't conceptualize what the future will look like, it will be better than the past, right?
Gotcha. Yeah. Okay. That does make sense. Yeah.
The lowest income demographic in the United States now, 75% or 80% of them have a cell phone, right?
Right.
When you were the King of England 100 years ago, you didn't have a cell phone, right? So the richest person from a different era is not even as well off as. And we didn't know AI 20 years ago when I started in the business, and now it's here, okay, and it's doing things that are incredible and scary and amazing. But
how does that affect your wealth management? Is it going to take away from a lot of people that are entry level? Is it going to empower them? How do you see AI affecting your
well, think about this. There's nothing wrong with clients, investors, just people in general being more educated, right? Mm-hmm. If we're not getting this type of advice, or not even advice, just education in our traditional school systems, fine. Maybe AI provides some of that. That's a good thing, right? Mm-hmm. The other thing is that AI, kind of like Wikipedia, it's the sum total of what everybody kind of puts into it,
where
right?
It grabs the information.
And so there's a lot of data that comes out of AI, but sometimes there's not enough context, right? Now AI provides a lot of answers, but for each person is different, right?
It does tend to hallucinate, just make stuff up.
Well, you can have that too, and so. And it's getting a lot better than that. Look, I've been on an airplane where there's nobody flying it, right? There's the plane's on autopilot.
Okay. Okay. That's what.
But I'm not getting on an airplane right now that at least doesn't have a pilot there that knows how to hit autopilot or turn it off and do that. Maybe in the future that'll be the case.
That's a great analogy.
But right now, having some context around it. And the other thing too is, really, when you say what differentiates us as a firm, little shameless plug here, right? But when we're dealing with our clients, we're giving them a specific solution one-on-one. We're not taking some sort of product or cookie cutter thing and just saying, here's what we got. Do you want it? Like the red Porsche example, right?
Yeah, exactly.
No, we're saying like, okay, do you want this and that? And let's talk about if we do it this way, what that means, or if we do it this way, that, you know, almost like when you're designing a home or a remodel, and they get to visualize, okay, I like this, or this makes sense, or I can sleep well at night if we do it this way.
Well, I want to grab that and let's play with that. Imagine that I'm going to ask you 2 questions, one pro, one con. We're, hanging out, having a beer, and you're going to give me the worst current financial advice that you can think of. What would it be? Hey man, you gotta.
Yeah, if you air this, then you've got to put that disclaimer at the beginning that says worst advice. No, I'm kidding.
Worst financial advice, yes.
It would be I would probably say to start day trading or chasing like the hot dot, right? That would be the first thing. But there's sort of a deeper answer that goes to that, which is letting your emotions control your decisions, right? That's actually where people go wrong.
Panic, fear.
Like you can invest in risky things. Let's say, again, we'll use Bitcoin because it's popular. You can invest in Bitcoin and it can go crazy, and you can have these emotional reactions. It's my money. I've lost my money with the decline. But if you actually don't sell it and you consider an investment and give it time, it'll probably work itself out, right? No guarantees.
Right.
But the emotional decision making is what really hurts people the most. And it's the one they think about the least.
They'll be like, here's financial advice, man.
Well, think about
Trust your gut. Go with your gut.
Yeah. That's it. Think of our plane example. You and I are on a plane, right? We're going to go down to Cabo San Lucas and have some fun. All of a sudden, you just hit like the worst turbulence you've ever been on, right?
Yes.
And my family's in aviation. My mom was a flight attendant. I don't get worried about that stuff, but let's say it just scared the heck out of me, right?
Yeah.
You and I are sitting there. If I just get totally emotional and I go up and try to open the door to get off this plane because I'm so scared, right? Instant death.
Or try to pilot the plane on your own.
Yeah.
What can I do? Yeah.
These are things that, like, when you take off, you might experience turbulence, right?
Yeah.
But if you just make this emotional reaction, it's not going to end well, right? Now, the flip side of that is when, I told you my family's back east. When I fly from Boston back to San Diego, you got to go over the Rockies. Almost every time the pilots say, hey, just a heads up, we're going over the Rockies. It's going to be a little bumpy. 10 or 15 minutes, just hang tight, button up your seatbelt, right? So it happens, but then you're just enjoying a drink and not worried about it because somebody's in control. Somebody's aware of it. But when that happens out of nowhere, it can be pretty, stressful.
Right.
So I don't know. I use a lot of airline
Actually,
analogies.
bad advice is good advice. So what's the best advice that you can give then? This is the best advice current that we can have.
I think the best advice is understanding, why you're investing or doing these different types of things. Like, what is the end result that you're looking for, right? That's kind of a generic cut on it, but
I think so. I need to give you context. Who are you giving this advice to? We already talked about the 20-year-olds. We talked about 30, but someone, let's say you're 50, someone our age.
Yeah.
What's the best financial advice? Hey man, this is my advice to you.
I would say that some of the, some good advice and that I would recommend is that don't get too concerned about what everybody else is doing. It kind of fits in with social media, right? Somebody's always got a bigger house, a faster car, they live close to the ocean.
It's all optics, it close perception.
Whatever that might be, yeah. Or don't, this portfolio did better than mine, or it's you stay in your lane and say, is this getting me closer to what I'm looking to accomplish, right? Is this getting me closer to financial independence? Is this getting me closer to, making work optional or having my child's education being paid for, those types of things?
So very specific to their goals.
Yeah,
to what they're
and I think the reason I would say that is because when I look at my clientele, that's the trait that they have, and they're successful, right? And they've been successful in their businesses and things like that, but they just focus on what they can focus on. They don't worry about the things that they can't control. Worry about the things that you can control, the amount of risk you're taking in the portfolio, what your tax planning strategy is, what fees you're paying for it. All these different things are like these little levers that you can control. I can't control if the president puts tariffs on or turns them off. I can't control what the Federal Reserve does.
Those are
with
the
interest rates.
turbulence of the plane.
Yeah. And so, those become the rules of the game, and then you just sort of play within them, and control those levers so that you can control your ultimate outcome.
That's good advice. Yeah, exactly. Yeah, and they need a pilot. They need someone that knows, their way around it. Gotcha. So you have a podcast.
I do.
You have a book.
Yep.
And what else you got? Am I missing anything?
Well, we have some. I do have a YouTube channel, and I've got some webinars that we put out there. Educational webinars, things like that.
So if somebody is really interested and they want your services, what are the steps that you take?
This is really complex, right? You go to Dyer, WM, like Dyer Wealth Management, .com. There's our website. And we do have an opt-in form, and we do have a weekly commentary newsletter, you will, that I put out, that I write.
People can subscribe.
Yeah, and this is meant for the consumer. It's not just jargon for the industry professional. I write about what's happening, and then I also have some wealth management tips and things like that. Some behavioral type of topics that we talk about, like, hey, you might be emotional around what's happening in the markets now. Here's how to put that into context. So I would say that's a really good place to start. The other thing is, and I don't see this as much as I used to, but people used to be really intimidated to talk to a financial advisor, right? Maybe they didn't think they had enough money or something like that. Financial advisors are here to help. It's our job, and it's what I've been doing for the last 30 years almost, right? And so I have this knowledge. I'm at the top of my game now, and I like to share that with people too, talking to somebody that is a fiduciary, which is kind of a term that you might hear a lot. That's somebody that really is independent and acting in the client's best interest. Now, you might say, well, doesn't everybody do that? Yeah, for the most part, this industry has got, a lot of great advisors and things like that. But there's one little issue there. Let's say I'm working at a large firm, which I did for many years.
Right.
I'm working at a large firm. I've got a client that I'm serving, but I'm also getting my paychecks working for the corporation, right? You can see I'm sort of in the middle.
Yeah.
I absolutely want to do what's right for you, okay? And maybe you need a conservative investment, to use an example, right? Okay, I can provide you with a conservative investment. But the company over here is saying, well, if you use our conservative investment, you get paid more on that. You see how there's a conflict of interest there?
Of course.
So, it was back in about 2008 when I left sort of the bigger firms and went out on this independent journey, which morphed to become what Dyer Wealth Management is today. But we work with the clients. You're at our global headquarters here, right? There's nothing behind the curtain. You're working directly with me.
With you.
And the advice I provide is based on the solutions that you need. I'm not compensated in any way, shape, or form by the products.
Or someone pushing you from the back to
there's nobody there. There's nobody there.
Yeah.
We're sort of looking shoulder to shoulder out into the horizon about what works and bringing that, to you to help serve what you need to get done.
That's awesome. Well, that's our time. Yes. Thank you so much, Tim, for having us. You have a great spot, and hopefully,
if you're ever in Bird Rock, anybody watching, come on down and say hi. You can't miss us. So
looking forward for episode 2.
All right, buddy.
Appreciate it, buddy.
See ya.
Thank you.